This is TreppWire Week in Review for week ending March 18th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, the Fed is raising rates for the first time since December 2018 and projects 6 more increases for 2022. A flurry of economic data was released. Retail sales rose last month, but came in below estimates. Wholesale inflation rose in February. Production at U.S. factories increased last month, but consumer sentiment fell more than expected with concerns over inflation and the Ukraine invasion. Manus, markets had a lot to react to, but most of the focus was on digesting the Fed announcement.
There was a lot of volatility again this week, as we've seen for several weeks thus far. I know a lot of our audience is in the commercial real estate space, which means that you're developing buildings, you're out at project sites, you're meeting with people that want to lease your buildings, you're arranging loans and so forth. So your eyes aren't on CNBC from 9 o'clock in the morning till 4 o'clock in the afternoon. And perhaps if you saw some of the day end numbers, you thought, well, this was a pretty good day, or this was an average day or whatever. But I think most of the days over the last week were really low-lighted, if you will, by incredible swings in valuations, indices, and treasury rates as well. So we'll get into all of that today. Before I do, I have to say that, we've been talking a lot about negative things over the last month, between the war in the Ukraine, higher oil prices and so forth. But for me, today is one of the happiest days of the year. It's right up there with the day before Thanksgiving, 4th of July, Halloween, the first day of the NCAA tournament, which, for guys like me, basketball junkies, you can kind of just sit down at noon, put all your cares aside and watch hoops for 14 hours every day. And for me, it's ahead of even Memorial Day, Labor Day, Christmas even. This is, one of those things. And when it falls on St. Patrick's Day, back in the day when people were in the office, when the day would end at about noon, so everybody could go have a long lunch and watch games and have a Guinness and some corned beef. It just made for endless memories. And in Lonnie's case this year, we have Texas Tech, where he's a professor and a high seed. So Lonnie, how's Texas Tech going to do?
Yeah, so they got the number 3 seed in the West region. They're playing the number 14 seed Montana State on Friday. They're so confident they actually asked me to be the 7th man on the bench. So I might be checking in during the first round of the NCAA tournament, to hit some of those logo 3-pointers. I think Texas Tech has a legitimate chance. It's interesting. Their coach left this year, took a job at their arch rival UT. Texas Tech was not slated in the top 25 in the preseason polls, and they've really rallied around that. I think they went undefeated over the regular season in their home gym, really electrified the fan base. And, we made the Final Four a few years ago, and it's really interesting, the publicity and everything that comes from that. The school enrollment has really exploded after all of that national recognition from being in the NCAA tournament. So there's tangible benefits to having a really good basketball team that makes it a few rounds in the NCAA tournament. So wreck 'em Raiders.
So I know we do audio only here, but, Lonnie came in today with his slightly too tight Texas Tech sleeveless jersey. And I think, next year, Lonnie, or maybe next weekend, if Texas Tech is still in it, go with the T-shirt under the jersey. I think that's a better look. It's a little bit more modern.
Manus is coming out swinging today.
Hey, I asked for an extra large, and all they said they had was a schmedium. So it is what it is.
Well, we can only see it from the waist up on the Zoom here today. Are you wearing the extra tight shorts from the 70s as well, or is that they give you the
that'll be a round 2 reveal?
Okay, there we go. So let's get into the economic numbers. Taking it from the top, last Thursday we talked about it during the podcast. CPI higher than expected, not by a lot, but enough to rattle investors' stocks. Sagged on Friday, a really sharp decline in the Michigan Consumer Sentiment Index. Stocks continue to fade. 2 points on the Michigan Consumer Sentiment Index. Number one, somehow the expectation was that it was going to go up this month. And how anybody made these estimates, whatever analysts were putting this out there, when we're seeing oil prices shoot up, interest rates shoot up, war in Eastern Europe. It just defies logic. But the number did disappoint. Stocks sagged off. And number two, investors don't like to go into the weekend long when there's this much geopolitical uncertainty. So there was a big sell-off on Friday afternoon. Monday was one of those days I was talking about at the top. For casual market watchers, it might have seemed uneventful. The Dow ended flat, but beyond the veneer of a Dow that kind of muddled through that day, real serious damage to the broader markets. The S&P got hammered that day, and most notably, rates really shot up. For the first time in about 2 weeks, we saw rates really head north. The 10-year that day rose 14 basis points, 2.14% at the end of Monday's close. The 2-year up to 1.87 that day. So we're now talking about, in the 2-year segment, something that was 10 basis points about a year ago, now being almost 2 percentage points, 2%. Tuesday, we got the PPI number, not quite as high as people expected, but we did get an upward revision in January. Stocks rallied on the news, I guess. The thought there was this might be enough for Powell to justify not going hawkish. Stocks really rallied that day. Oil prices fell sharply. And then yesterday was the big news, right? Everything before that was kind of like preseason football. Yesterday was the regular season when Powell came out and announced the rate stuff, 25 basis points higher. That was as expected. I think there's a big exhale that it wasn't 50, although that was kind of 50 was kind of a long shot. But the hawkish tone, 6 more increases in 2022, 3 more in 2023 with a peak rate next year of 2.75 really got people's attention. Stocks really plummeted for about 90 minutes. Interest rates shot up. The 10-year got as high as 2.25. The 2-year touched 2%. But by the end of the day, stocks recovered, and today's another good day. So a lot going on and a lot for you guys to chew on.
Yeah, let me jump in here with a few things, man. I think the Powell stuff, everyone, we've been talking about that for a few weeks about what are they going to do. They actually laid the plan out pretty earnestly yesterday, I think. I did see on Twitter, though, that people were roasting Jerome Powell for the Rolex Submariner that he wore to the to the presentation. So there's some memes out there on the Rolex Submariner. I think a few other things. We talked last week about consumer sentiment not really having a feel of a negative impact. You hit on that on the University of Michigan index consumer sentiment going down, lowest level since 2011. We're going to start seeing retail sales probably slow when the sentiment drops. Then people start holding onto their money a little bit tighter. The other thing that was of note this week is travel near 2019 levels. I think 90% for American Airlines, Delta, Southwest, United. So their Q1 forecasts are positive. So even with all of this other geopolitical and uncertainty in the market, it seems like at least business travel, leisure travel are potentially up. So maybe that bodes well for the CRE marketplace. It's really interesting. I think as you mentioned, if you had taken a snapshot view on any of the trading days this week, you may have had a very different opinion of what the week was looking like, depending on when you signed into CNBC or one of the other trading shows.
There's a lot of uncertainty in the market right now that I think, again, for people that are kind of tourists in the equity market and are not deep insiders into fixed income, it's probably eluding people at this point, right? And a couple of things are going on right now that I think are contributing to jitteriness, but have not yet turned into full-fledged panic, right? Last week, we talked about the margin call for Peabody Energy. They were on the wrong side of about a $500 million bet on energy hedges. Last week, we also talked about nickel, where a big firm in China was on the wrong side of an $8 billion trade. The nickel markets froze. They took the unprecedented step of basically stopping trading in that market. JP Morgan was a huge counterparty to that nickel trade. And essentially, an agreement was made that would give time and money to that Chinese operation to not have to come up with $8 billion tomorrow. So instead of JP Morgan being on the short end of an $8 billion loss because they can't take or they can't get the cash from the other counterparty here, they basically lent that counterparty the money to pay JP Morgan, and now they have some IOUs. And, that probably soothed the market in the short term, but the bigger issue now is who else is out there, right? Who is not creditworthy because they're on the wrong side of $1 billion or $2 billion or $3 billion trade, right, in commodities or something like that. We saw another story this week with TreppWire, which is a commodity dealer, offices all across the US, South America, Europe, the Far East. Their debts collapsed this week in price because they too were on the wrong side of a commodity trade. So they have a corporate bond out there that's due in 2026. This was shared with me by a listener, due in early 2026, has a coupon of just under 4%. This bond was trading at a small premium as recently as February. Over the last couple of days, this bond has fallen by about 17%. It's trading at 83 now because people are out there thinking, okay, they're not going to be able to meet their obligations. They're not creditworthy anymore, or not nearly as creditworthy as they had been. And therefore, to buy their bonds, we're not going to accept 3.5% rate anymore. We're going to need like 8% or 10%. And I think we'll see more of these stories come out as we see this volatility in oil and other commodities, copper, natural gas, and so forth, right? There has to be somebody out there when oil was 120 who put hedges on saying this is going to 160. And now that it's 95, that guy could be on the wrong side of $1 billion trade. And the guy he owes money to is, a bank that will be looking at $1 billion loss. And we can get into a lot more of this if, we have some metaphors for this using NFL betting and casinos. It's probably too much inside baseball for a 40-minute podcast. But if anybody, would like to know how this works, we can talk about it more offline, or if we get enough interest in there, we can go back into a longer session on this.
Manus, how would you say this is impacting things beyond CMBS and CRE?
Well, as our audience knows, we've talked about this periodically. We do have a franchise in the CLO business, which tracks corporate credits. I went to our resident expert, Andrew Jacobs, this week, along with some high yield traders and some leverage loan traders. My curiosity about this was in response to a Bloomberg article, which said, even though leverage loans are not getting crushed in aggregate, they are getting crushed for non-energy. And Andrew kind of confirmed this for me, saying that on average, the dollar price of leverage loan credits are down 2 to 4 percentage points, dollars. So maybe down from 96 to 93, something like that for cheap stuff, and 99 to 95 for high quality stuff. But he did point out that the energy is kind of keeping the aggregate numbers from looking worse. So you may have situations with tenants of yours on the CRE side where, if it's a commodity dealer, energy company, bank that trades with these things, we saw in the great financial crisis, AIG, Lehman, and others wrong side of big trades, and that became an issue. A lot going on, and I don't think the final word has been said yet.
So pivoting to the CRE market, give us a rundown of the state of the CRE lending market.
Wow, I've done a lot of talking already. We're only 15 minutes in, and
I haven't even asked you about baseball yet.
Normally I don't go at this pace unless it's a 3 coffee day. This has been a 2 coffee day. I don't know. Maybe I went for the extra calf, not knowing it was the wrong pod. Let's talk about the state of the CRE lending market. We'll talk about a couple of things here. I'll use a term I've used many times over the last month, that the markets are not panicked, that they're orderly. Things are wider, but not frozen, and people are still lending. I wanted to make sure I was spot on that, and I wanted real evidence of that. So I went back to a couple of longtime friends and people in the industry that I've known for 15 years or more to make sure that we were right here. And in every case, what they said was confirmation of what we said last week. People are lending. They're lending at higher spreads than they would otherwise to compensate them for taking on more risk and more volatility. But nowhere are they putting rates so high as to signal to the market they don't even want the business. They want the business at a rate that compensates them for the risk. That was good news. Another positive sign this week was we saw a deal come in that was a conduit deal, which one of the issuers that is a regular dealer in the market came in with today. So clearly, if you're sending us a prospectus and a tape, you have confidence to go forward with a new issue in the conduit space today. All green shoots that the market is functioning, although for borrowers at higher rates than what they're used to in the last 2 or 3 years.
Yeah, I think that's the reality that the borrowers are going to have to face, is that it's just going to cost them a little bit more to finance. Their cost of capital is going to be increasing, and it'll be interesting to see how long that trickle down effect takes to get to the actual asset valuations or property transaction volume. I think we've seen several articles across the spectrum for almost all property types that the last 12 to 18 months have seen records both in price and in volume. And it'll be interesting to see if this makes any impact at all. I saw a thing on Twitter this week where a buyer was looking at an apartment complex. The appraisal came back $8 million less than the purchase price, and the buyer just ponied up the additional $8 million in equity to close the deal. So it'd be very interesting if that was an anecdote, or if that's kind of what we're going to start seeing across the spectrum, not just from a lending perspective of the cost being a little bit higher, but also if the market starts to slow down, some of these contracts are, at a purchase price that the market doesn't support. Are buyers going to continue with the transactions, or are they going to walk away and lose some of that earnest money that they put up on the front end of the deal?
We're going to get into some really detailed numbers on some of the recent deals that we've seen coming through to give people who are borrowers out there or property owners a sense of just how much higher rates have. I think kind of putting a ribbon around this for those people that are developers or owners of properties or looking to refinance would be helpful. So here are a couple of data points that we looked at on deals that have come in recently from the audience of issuers that bring CMBS deals to market. The latest stuff that we've seen had a weighted average rate on the loans of 3.85%. So close to 4%, probably 30 to 40 basis points higher than the weighted averages we were seeing 3 months ago, 4 months ago. But that only tells part of the story. And by the way, it's 3.85% on a weighted average basis, 4.06% on an average basis. And what that tells you is the larger loans get better pricing than the smaller loans, right? You're getting 375 if you're bringing a $100 million loan. You're getting 415 if you're bringing an $8 million loan, right? There's a bifurcation there. But I thought this was really interesting that I looked at loans that were originated before February 15th of 2022. And so that was before the invasion of the Ukraine, before oil hit $130 a barrel, and before the 10-year got as high as 225. So the weighted average rate of stuff we had seen recently that was originated before 215 had a weighted average coupon of 3.60%, probably close to where we were 3 or 4 months ago. Anything issued or originated after or on February 15th, 2022 was at a rate on a weighted average basis of 440. So we have seen an 80 basis point uptick in rates in the last month from where we were in early February. That should give you a sense of how much higher borrowing costs will be if you're a developer, if you're a borrower, but it probably doesn't even reflect the fact that we saw the 10-year hit 225 this week. That's probably based on an average 10-year of about 2%. So if we look at these numbers again in 2 weeks, that 440 could be 465. And I'll let you jump in, Lonnie, for a second. So give us a little perspective on how you feel about that and how that dampens cap rates.
Yeah, I mean, it has historically meant that cap rates are going to increase. It stresses your debt service coverage ratio from an operations perspective. I mean, it makes the deal that was marginal before probably not pencil now. And so it'll be very interesting to see how people react to this, because I agree with you. I think this is just a precursor to probably what we're going to see over the next 6 to 8 weeks with the rate increase and everything else from the Fed. I don't think we've hit the peak rate. So as you're underwriting deals, if you get a deal under contract and you have a 60-day due diligence period and you have another 60 days before closing, you're 120 days out from contract to close, you might not have certainty of what that rate's going to look like upon close. And so you're having to do a little more due diligence, making sure you sharpen your pencil on your underwriting analysis, all the stuff we've been talking about for the last few months in terms of underwriting, rent growth, and all of those things. Like, those become less aspirational and almost requirements in order for the deal to make sense over the hold period. So I think in a traditional market setting, these would be things that would actually shift investor behavior. I'm not sure in today's market that's flush with cash and capital that we're going to see a direct correlation between increased cost of capital or borrowing costs and a direct implication to slowdown in price or transactions, just because the marketplace is just, I remember in 2008 when the subprime lending crisis was like just about to take hold. Like, I think at the time President Bush was in office and said we got a little punch drunk over the lending and home purchasing, and it feels like we're a little bit there. Like, people know things are teetering, people know cost of capital is going up, people know that deals are marginal, but I don't think they're really taking that into consideration in the way that a prudent person would maybe look at it. And I think you go back to the commodity trading stuff that you were talking about earlier. These deals work until one day they don't. And for some people, they're going to be the last person that bought at the peak, and they're not going to be able to get out from underneath it. They're going to have underwritten aggressive rent growth, cap rate compression, and the market's not going to respond to that. And they're going to be left holding an asset that doesn't cover debt service and they're not able to sell or refinance out of.
So I'll throw a thesis out there and I'll let you react. For our audience out there, we really don't script this a whole lot. So sometimes I'll throw Lonnie or Martha a curveball, and this might be one of them. In the CMBS market, because everything that they're doing is meant for securitization and getting it off their books within 90 days at the most, if not, within 10 days of the last loan that's made for a securitization, right? They have to respond very, very quickly to moves in interest rates because their cost of funding moves every single day. My thesis is that insurance companies and banks don't have to move as quickly, and that may keep cap rates lower because they will still be quoting things kind of more aggressively than the CMBS market is, maybe even picking up market share for maybe the next 60 to 120 days, just because they don't have that pressure on them of mark to market and a quarterly P&L.
Yeah, I think that's fair. And I would say the non-CMBS lenders are probably going to pick up market share over the short term, just because, and we've seen this even with the distress. Like, they have some flexibility, they have additional ways, additional levers that they can pull to keep things, serviced and in good standing, whereas CMBS is very rigid on the covenant side. You make a valid point on the securitization side as well. They're not bound to some of those same levers, and so they have the ability to be more competitive. And I think, if I'm sitting in their shoes, I'm viewing this as a really ripe opportunity for me to go out and actually acquire some additional business. I don't think necessarily, though, the underlying risk changes too much. The profile, we're in an overheated market. We're 12 years plus into what's historically been a 7-year cycle, and at some point, the steam's going to start, whistling out, and things are going to start falling apart. And I'm usually optimistic and bullish on life in general and in CRE, but I think, we're starting to see some of these things. If they were happening in a vacuum, maybe interest rates on its face isn't enough to shift the market. But I think you have interest rates, you have the uncertainty, you have all these other things that in conjunction really make this, a time where you're going to start seeing people be in a position where they look back 18 months from now and wish that they hadn't pushed the envelope.
I'll throw out one more set of data points here. This comes from one of our super analysts, John Flanagan, who works behind the scenes, but he's one of my go-to guys, along with Max Nelson, in terms of getting me data to help support this podcast, kind of toiling heroically behind the scenes, working for a boss who doesn't have much patience and only describes about 40% of what they really need. So they have to repeat the work 3 or 4 times. He did a pull for me of data with the average coupon of loans maturing over the next 24 months. And we've talked about this in the past, that lower interest rates gave people a whole lot of juice to refinance and take more proceeds out of a deal than you might otherwise do. If you're refinancing from a 5 to a 3.25, your DSCR on the new loan explodes higher and you can get more proceeds out of this. So here's the data, and I'll let Lonnie kind of put his spin on this, but we looked at the average coupon of loans maturing in the next 24 months. 5-year loans that were made in 2017 or 18, average coupon there 4.45. For all loans, the average coupon 4.65. So all that juice that people were getting out of the deal, if they were going into a loan with a handle of 3.25 or 3.5, is now gone. And now we're in an environment where if the 10-year goes to 2.75, which if that's, if we're saying peak Fed funds rate is 2.75, it's almost impossible to see the 10-year not going to 2.75. Now they're in a position where they're refinancing into something which is a point higher than where they are today. So give us your thoughts on that, Lonnie.
Yeah, I think a lot of people have gotten rich over the last 10 years doing exactly what you described, where they financed a property, they benefited from lower interest rates, they refinanced, they took out owner equity distribution, and they were able to reinvest those funds and effectively do it over and over and amass a really good portfolio of properties. If you come back at par now and you refinance, you're not getting that juice, as you mentioned. If interest rates are higher, in some cases, properties are going to have a hard time actually being refinanced. Now, all things considered, this new version of CMBS, loan to value ratios are a lot less than they were. Properties weren't being financed originally on wish and hope and prayer underwriting. They're actually based on, in-place financials, unless there's, a very solid story that goes with it. But you're going to see a lot of property owners that benefited from this over the last few years, here in a few months, potentially face the other side of that coin, where it costs a lot more to refinance. There is no ability to cash out. And in some instances, they may have to bring some capital to the table in order to get their deal refinanced.
If I'm a CMBS investor, I'm looking at IO bonds now. I'm assuming that a lot of the cuspy stuff, the owner comes back to the CMBS special servicer and says, my cuspy loan, my 1.20x DSCR, I can't find refinancing. I need another 2 years. Can you give me a 2-year extension, which really benefits the IO holder? I'll close with one more point. I'm just kind of completely hijacking Martha's outline for this, but in the past, borrowers could benefit from trading down the curve to a shorter loan, right? If rates went up and they said, well, I certainly don't want to lock in at a 5% 10-year right now, but I can go 5 years and get 3% still because the curve is steep, that was an option for them. Or if they wanted to tap the floating rate market, they could. Now, with the 2-year at 2%, the 5-year right on top of the 10-year, and possibly short-term rates going up to 1% in 4 months, 1.5% by the end of the year, that floating rate loan is also not providing you much juice. So no matter where you look, there's no way to kind of cut a corner to save interest rate costs by making a shorter loan. So more to be discussed in future podcasts.
Turning to property sector news, let's start with office. We had a couple of negative stories that went out this week.
Yes, we had a potpourri of some crabgrass, some green shoots, and a new term which I'll throw out there, which is mixed green, which is what I usually get.
Is that a salad?
At my age, I got to go for the mixed green over the French fries these days to keep that cholesterol down. Start off with Chicago. This will come as no news to people who've listened before. One office there became REO. That's 175 West Jackson. It's a big CMBX 7 office loan. We wrote about this in TreppWire this week. DSCR had been under 1.0x for 7 years, hit just 0.34x in 2021. Occupancy was 65%. That property is now owned by the CMBS Trust. Another one, 135 South LaSalle. It's a $100 million loan, also in CMBS. It backs a 2015 deal. We had mentioned before, both on this podcast and in TreppWire, that the owner of that property was likely to go deed in lieu. This month's data showed that the special servicer, in fact, believed that this loan would go, or this property would go REO in the next coming weeks. TreppWire vacated that property a year or two ago. They had 800,000 square feet there. So no surprise there. Another piece of crabgrass, I hated this one because I do like good stories. Amazon in Seattle told their employees to stay away from their downtown Seattle office for this foreseeable future due to crime and fentanyl use in the immediate area. Amazon has 1,800 employees at 300 Pine Street. That property does back a CMBS deal. No credit risk there. Amazon is in place for another 11 years, I think, or 15 years. So for CMBS owners, bond owners, I think this is a problem. It's not. It's a bigger problem for the community and the restaurants and bar owners and the coffee sellers and so forth there in that town. And we hope that city can turn it around.
The one, if you wanted to have some green shoot to that story, man, is Amazon does have several other buildings that are not adjoining or adjacent to that, but in the same general area. And they haven't relinquished their employees from coming to those buildings. So they still have a presence. They maybe are going to shift some of these, workers to some of those other locations. And so for the city, maybe those downstream impacts to the restaurants and others won't be as hard felt in that particular location. Clearly they will be, though.
On the green shoot side, this is from Rich Bachman of The Real Deal. Apollo Global Management is acquiring 100 West Putnam in Greenwich, Connecticut for $200 million. Why is that a good story, and why did it capture our attention? Well, the property backs a $66 million loan, which is part of CMBX 6. In fact, it represents 15% of JP Morgan 2012 CBX. So what was once a credit and a risk will not be a risk. This particular property, 155,000 square feet, was only 68% occupied as of last September. So not a sure thing with the office market being where it is and work from home. Great to see Apollo come in there, pay a premium price for this, and take that risk off the board for both bondholders there and for CMBX longs. Moving on to mixed green, we have two things. One, IBM taking on space at 1 Madison in kind of that Madison Square Park part of the city, 330,000 square feet. They're consolidating from 9 other offices in Manhattan, 2 of which touch CMBS deals, one at 550 Madison, one at 51 Astor Place. Why is this a mixed green? Well, that 1 Madison is a real Class A property. I'm sure IBM is paying a premium price for this. It's also in a part of the city that's not all that easy to get to for commuters from the suburbs. So for IBM to pay a premium price for an office like this is green shootish. The negative side is it's a little bit less space than they have now in their 9 offices, and there will be vacant space in those 9 offices across Manhattan. Another mixed green, this is in Houston. Enbridge is reducing its footprint in that city by more than half. That's kind of the downside of the story. The firm has 620,000 square feet at 5400 Westheimer Court. It's the only tenant in that building, and the building backs a fairly sizable CMBX loan. It backs a 2014 C25 JPM deal. So that is one to watch. They are moving into 260,000 square feet which is the green shoot part of the story, at 915 North Eldridge Parkway. And, that's the positive sign of that they're not going work from home entirely. They are signing on for more than 250K in the energy corridor.
Yeah, I think this is going to be the story for several of these markets going forward, is a right sizing or consolidation of some of their footprints. Enbridge is a Canadian pipeline operator. So again, in that Houston market, they're always susceptible, especially with some of the political overtones that we've seen as it relates to oil and gas. So it'll be interesting to see how that market continues to right size. I was actually up in New York this week at our office in New York, and I can tell you there's a lot of vacant office space on my walk from the hotel to our office. And so it's really interesting to see more for lease signs than I've ever seen, more empty offices, ready for release, sublease, et cetera. So it'll be interesting how these right sizes actually continue to play out. Hopefully it's not indicative of a systemic issue that we're going to see across these large cities.
There will be winners and losers. It wouldn't surprise me if IBM spend is higher than it was across the 9 properties. But of course, it all goes to that one property owner, which I think is SL Green, if I'm not mistaken. And it comes at the expense of some of these legacy buildings, around Manhattan. We'll pivot quickly to, in retail, one I wanted to point out was, this is a story you don't see every day. It's a property owner that bought a mall in 2012 without losing their shorts. In this case, it's Hines is the owner, or was the owner. The Minneapolis Star-Tribune reported that the 400,000 square foot Galleria, Edina in Minnesota, was acquired for $150 million, $376 per square foot. Hines paid $127 million in 2012. So we like that. We like the fact that we have a mall sale that was marginally profitable over the last 10 years. We'll take it.
Yeah, and it wasn't purchased by an NFL football team. But I do think, Manis, that was a great segue, since I'm still in my Texas Tech jersey and I'm over here practicing my keeping my pivot foot on the ground as I'm warming up for the game tomorrow. So the pivot reference is very, very nice. So for some multifamily stuff, if you haven't heard of, we have this thing called the Googler. You can Google Lenexa, Kansas, because there was a recent sale, 80 unit Fairways at City Center in Lenexa, Kansas, population estimate about 50,000, just sold for $565,000 per unit. Wouldn't have been that long ago that we would have been talking about that kind of a price in the Bay Area or some sort of top tier city across the US. I don't think Lenexa's in that top tier, probably not even in the secondary, maybe not even in the tertiary market. But this property, 80 units, sold for $45.2 million. The footnotes were that it's the first luxury rental villa community located on a golf course. Completed in 2020, it's about 18 acres, has villas with about 2,300 square foot of finished floor space that span 2 levels, and it's next to an adjacent growing mixed use of retail and civic amenities. So, again, record price, really big numbers for a 80 unit multifamily development. Miami makes the news again. We have a record-breaking multifamily sale in Miami. This comes from The Real Deal. They report that Harbor Group International and a few others together acquired Parkline Miami Towers for about $550,000 per apartment. Sale was reported at about $450 million, which would be a record for the city. This is a little bit more traditional at that price point. Assets of 2 44-story and a 47-story residential towers, 2-acre Sky Park amenity deck with 150-foot above street level views that connect the towers, and then community amenities, infinity lap pools, quarter-mile running track, indoor and outdoor fitness centers. I mean, you name it, they have it. So that's good news for Miami. And then heading out to Durham, North Carolina, this property, 176 unit Nova Chapel Hill, was sold to Harbor International Group for $202,000 per unit. They purchased the asset for $35.48 million from Dasman Residential. Just to speak to the type of value appreciation we've seen in some of these secondary markets, Dasman acquired the property for under $19 million in 2019. So we're, probably not even 2 years removed from the sale at 19 million and the property traded again for 35 and a half. This is interesting because this deal is part of a string of recent deals in the Triangle submarket in Durham. So it adds to a growing momentum for the Triangle's multifamily market as population continues to grow and the rents continue to rise. So I can just speak from my experience in the marketplace. Multifamily, maybe more than any other asset class, really benefits or is hampered by the strength of the local submarket. So if you can string 4 or 5 really good multifamily sales together, increasing rents, that theory of competition really plays well in the multifamily space. And so they're able to reap the benefit of that. So just a couple of stories we wanted to cover this week on the multifamily side, all pretty much good news from a sales price per unit and a total sales price perspective.
While you were doing that, Lonnie, I was just going through my news scroll and I saw another one from Durham, which I got to throw out. This one just was extraordinary to me. This is a record-breaking sale. I don't even know how to describe this. Micro apartments in Durham. So this is apartments that average 500 square feet per unit, went for an average of 285,000 per unit, right? It was probably 2 years ago that would get you a 3-bedroom apartment or maybe a small house, right, on half an acre in the Triangle region. I mean, at 500 square feet, that's like a morgue. They're sliding you into something, right? I mean, that 285,000 K per square foot, that's unthinkable.
Yeah, the micro unit concept was really taken off over the last few years in Austin, and apartment developers had done a lot of market research to say, what are tenants willing to give up in the form of square footage and not sacrifice on price, so the developer still could reap the benefit of the higher rents and the higher sales price. And it's really interesting. I think this is where we got to the amenities race and some of these experiential developments where you have a central courtyard, you have areas where the community members can gather and enjoy themselves outside of the unit, because to your point, most of them have no washer and dryer connections. Some of them have shared bathrooms. There's in some of these zero parking for vehicles. It truly is like a new style of multifamily living, which it's interesting. It coincided some of these developments with COVID, where you're trapped in your apartment for 2 years, then those 500 square foot units, the walls start closing in pretty quickly.
That's when you need the dog run.
Imagine you got a couple kids in there.
Yeah, that's brutal. Shout outs. We have a lot of shout outs this week. Charles T always enjoys listening to the podcast and is a first-time inquirer. He asked us about the data on medical offices, specifically Hawaii. So I know we probably reached out to him and sent him that information. Sean M is an MBA student at Texas Tech. There you go, Lonnie.
Recom Tech.
There you go. And was reaching out for information on risk retention data. Kieran C said the podcast is the most interesting and entertaining financial podcast available. I look forward to it every week, and he's a bit of a nerd, he said. Those are his words. Jan F., who we haven't heard from in a little while, reached out when we were talking about gas prices and how that impacted hotel room demand. He said he agreed that gas prices do not impact demand. Travelers just go to a different place, but they still go. So thank you, Jan. Darkfire Capital on Twitter gave us a shout out for the greatest live album ever, UFO Strangers in the Night. So Manus, I'm sure it's probably someone in your crazy cult that agrees with you on that. Capsag Pug responding to a tweet about people who argue the landlords want you back in the office. So he commented on that. UWS, it doesn't happen often that you hear technical stuff communicated in such a fun way. Great learning keeps me up to speed on the market. And that was, I think, a review on Apple. Finance Guru, one of the most educational finance pods I've ever listened to. And Lil Hilk works in the CMBS industry and uses the podcast to stay up to date on what's happening. So if you do have Apple and you want to give us a review, feel free to do that. We do give those a shout out. You know, if you were feeling tired this Monday because of daylight savings, there might be hope. Senators have unanimously voted to get rid of that. No more daylight savings forever. Who knows if it'll actually pass, and who knows if the president even believes in that. But for those of you that think it's a bad idea, and I know there's some of you, At least you'll be able to golf after work. And that Monday after is brutal. Monday morning, tough. Won't miss it.
I'm not a buyer of this thing. You know, I got to say that I like the fact that they pushed it out after Halloween. So there's a little bit more daylight on Halloween. Kids can trick or treat a little bit without having to worry about crossing streets and not being seen. But the notion of sending your kid to a bus stop at 7:20 in the morning and still having it be pitch black as commuters zip by at 15 or 20 miles per hour faster than they should be going, that's a little alarming for me. I'm a hard no on changing what we have now.
You could just move to Arizona, where I don't think they change the clocks, right?
No, they don't. Standard all the time.
So who are you taking, Martha, Lonnie, in your final four? Quickly before we wrap it up.
Oh, you know what? I have Gonzaga taking it all. That's all I remember of my brackets. And they
All right,
probably
Lonnie.
are already busted.
Yeah, so I'm one of those creatures of habit. So every year, regardless of seeding, I pick the Kansas Jayhawks to win the tournament.
There you go. I took last year, I got 3 out of the 4, but one of our listeners really took me to the woodshed because I picked North Carolina in the first round and they lost in the first round. And this person went to North Carolina and said, even I wouldn't have picked them to go to the Final Four. But this year I got Houston, Gonzaga, Auburn, and Purdue. I started out with Colgate, Vermont, Davidson, and Bryant, but then I realized it wasn't a fencing competition. It was basketball, and then I fixed my bracket.
Well, here's to your bracket being unbusted for at least a few rounds.
And as an aside, I'm planning to go to the second round in Greenville, South Carolina, where I think it's going to be Duke and Michigan State if they both win. If there's any listeners there that would like to meet me for a beer between games, send us something on Twitter, direct message us, or send us an email and let us know. And I'm happy to buy you a beer between games.
You can't expense that. And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. And give us a review. Thanks for listening and stay well.
Go Gonzaga.
Please.